Our goal is to increase capital tenfold over the next 3 to 5 years. Of course, not all companies that have not yet gone public are suitable for this. Most of these startups will close and never return money to investors. In this video, I will break down 5 principles of early investment strategies that allow you to aim for the biggest returns in this market. Principle number 1. Invest several years before going public. In the previous video, I showed how Andreessen Horowitz demonstrated that all investment income has gone private. I conducted my own research and selected the largest IPOs over the past 5 years. I then looked at what would happen if an investor bought a company on the first day of trading and, for instance, held it until today. The result of such a strategy would be a loss for the investor. More precisely, they would earn 1.7%, but considering the dollar inflation, it would result in even greater losses. If an investor had invested in the same companies, Roblox, R&B, Uber, Instacart, Reddit, and so on, at the pre-IPO stage before they went public, meaning when the company's valuation was over $100 million and they attracted rounds and data. Next, such a strategy provides 88% annually, and due to compound interest, it results in a 65 times increase in capital. By the way, in this list of the largest offerings, there was one unicorn, Roblox. It gave investors more than 6,000 times returns, which is crazy profitable. In our strategies, we call such companies gems, meaning companies that have provided over 100 times returns on investments. They're called gems, which translates to diamonds. A simple example, if you invest in a company with $10,000 and it turns out to be a gem, you will get $1 million in return. The problem is, we do not know which company will become a gem, and the only real way to increase your chances of success is to form the largest, most diverse portfolio possible. In this case, even a small investment of $1,000 might bring in hundreds of thousands of dollars in returns. Principle number 2, invest in fast-growing markets. Let's say if an investor makes this simple decision, they essentially get a free profit environment. According to forecasts, the blockchain market is expected to grow by 86% annually, and the artificial intelligence market by 38%. However, within these large markets, there are always interesting sub-niches. For example, the blockchain gaming market is growing by 68% annually. Therefore, the second principle of the strategy is to invest in rapidly growing markets to gain additional free income potential. Principle number 3, build a portfolio from 2 types of deals before the crowd. One, pre-IPO. This is a company that we invest in several years before going public. We buy shares. The company has a capitalization of more than $100 million at this stage and above. These are very solid deals, growing 40 to 100% annually. We buy, wait for the company to go public. 6 months later, we get the shares, sell them, and pay out returns to investors, while the fund takes its commission on the profits. Another type of investment is crypto startups. Small, riskier, but extremely profitable story when we want to earn a lot at once from a single deal. Crypto startups move faster, while typical companies take an average of 10 years to go public. That's why we focus on the final stage of investments. So, crypto startups can reach a crypto exchange in just a few years, distribute some tokens to their investors, and then over 2 to 3 years, they distribute these tokens. Thanks to the low base effect, this results in very high returns. It is in the crypto startup market where you are most likely to get a gem investment, meaning your $10,000 could potentially become $1 million. So in fact, you can achieve financial freedom with just one deal by continuing to invest regularly. And as I mentioned earlier, the best way to catch a gem is to keep investing and build the widest possible market. As a result, solid deals will form the foundation of your capital, while approximately 20 to 30% of this portfolio will consist of crypto startups, increasing your chances of reaching financial freedom not in 7 years, but maybe in 3 or 5 years. Principle number 4, invest with top investment funds. According to statistics, 9 out of 10 startups close within the first 3 years. There are a million different reasons for this. That is why the portfolio is based on IPO deals, meaning companies that have already proven their viability and have overcome the startup death valley. However, for crypto startups, it is crucial to have a top-tier fund on board, because as soon as a renowned fund like Andreessen Horowitz, Sequoia Capital, Coinbase Venture, and several other funds that we call Tier 1 or Diamond funds comes in, the startup's chances of success multiply significantly. Then, a startup's chances of success increase significantly. Statistics from top venture funds, particularly in the crypto industry, show that they make profits about half the time, while the other half results in losses. However, those companies that went public and were successful show returns of 10, 20, 30, or even 40 times their original investment. Some funds even show 40x returns. That is why this is one of the main criteria when choosing a crypto startup. Of course, the team the theme is important, the product is important, and so is the team for the next 10 years. But if a startup does not have a top tier fund on board, I skip those investments. In 2022 to 2023, crypto startups that went public generally did not have a strong fund on board. Conversely, crypto startups with strong investment funds delayed their exit, waiting for the key interest rate to drop and a new crypto industry season to begin. Hence, nearly all my early stage investments without top tier funds practically turned into nothing. That is why I consider this criterion a primary factor when choosing crypto startups and deem it important for pre-IPO investments. Principle number 5, I build an investment portfolio of 20 companies or more. This protects you from a large number of risks because any single company can face issues. But with a large portfolio, you generally achieve quite a good return. Plus, if you also invest in a rapidly growing market, that return also comes as a bonus to you. But it's important to build a diverse portfolio. And finally, another reason is that when you have many companies in your portfolio, your chances of success significantly increase. For example, in an analysis I conducted recently, among the largest IPOs over the past 5 years was Palantir's IPO, which provided investors with a substantial return. And if he just missed that deal, he would not only get 1.7% from this dull and dreary market, but he would have losses in his portfolio. Or, for example, the company Roblox, which delivered over 6,000 times return. The only way not to miss such an investment is to form a broad portfolio at the start and then invest regularly, preferably every week. This way, you will have 52 opportunities in a year to achieve financial freedom. To take the next step, you can visit the investment platform to check out today's open deals or leave a request with my portfolio manager who will select deals for you and help process and complete them.